right in my first job as an economist, I think about a year into it, I got called for a radio interview, and I was working in Beijing at the time, and the Chinese GDP report had come out. It was GDP had grown about 10.3%, if I remember correctly, in year-over-year terms, which was the part that I was really interested in, making sure I knew what came after the decimal. And the show host, the first question when I got on air was, so tell me, what does it feel like to live in a country where GDP is growing by double digits? And my response was, because as an economist, you pursue the career or you look for a job as an economist if you don't want to talk about your feelings. So I was not prepared for that. I don't think I'll have many jokes along the way. If I do, they're going to be bad, so I apologize in advance. Let me tell you a little bit about what I've been thinking about what will affect the U.S. economy, as well as the economy here in Lansing over the next year. So about this year is the inversion of the yield curve. So long-term interest rates, ordinarily it costs more to borrow for 10 years than it costs to borrow for 3 months. That's true for consumers making a consumer loan. It's also true for governments. But that has been, that ordinary relationship reversed between May and October of this year in what in financial market speak is called an inversion of the yield curve. So the cost for the government to borrow for 10 years was for a few months less than the cost for the government to borrow for 3 months. Yield curve inversions don't cause recessions, but historically, ahead of when recessions have happened in the U.S. economy, yield curves have inverted. So we don't forecast a recession in 2020. And let me lay out our reasoning for why we think we're going to see another year of solid growth in the U.S. And why we think that this expansion, which is already the longest economic expansion on record going back to the 1850s, is going to continue at least into 2020. The first reason relates back to the yield curve, which economists love to talk about in part because other people think it's so boring. And it's about foreign capital markets. So in the United States, interest rates are very low right now. In Japan and in the euro area, interest rates are actually negative. So the government of Japan, the government of Germany, if you want to lend money to their governments, you have to pay them to take your money these days. You have to pay the German government 102 or 103 euros to get paid back 100 euros in 10 years. And so what that means for investors in those foreign advanced economies is if they want to invest in a government security where they are almost assured to be paid back, and they know they're going to lose money domestically, to the extent that their investment policies allow them to do it, they're reallocating out of their domestic capital markets and putting more money in the United States because a U.S. 10-year government bond, even if it's only paying 1.8% interest, is a lot more attractive than a government bond where it's paying a negative yield. You know you're going to lose money if you hold that bond to maturity. We're still guessing as to whether the Fed is really done with cutting interest rates or not. If you look at the level of interest rates implied by financial market prices for the end of next year, it looks like financial markets think that there's some possibility that the Fed will cut by another 0.25 percentage point over the next 12 months. We think that that's less than a 50-50 likelihood. So short-term interest rates in money markets will stay around 1.6%, flowing through to a level of interest rates for consumers and for businesses that might take about what's happening with the trade negotiation. I think a deal is going to be elusive, and so out of that, I think more likely than not that the Chinese currency weakens. I've also seen China's central bank cut interest rates. China's unemployment rate is up by around 0.5 percentage point over the last year, which is a pretty big increase for unemployment rates. Chinese economic data is super hard to interpret, very noisy, a lot of statistics not constructed in the same way that they are in the United States, and a long history of unreliable economic data in China. But I think that particular unemployment rate, which has only started to been announced over the last couple of years, is a strong sign of what's really going on there. You know, slowest GDP growth since at least the early 1990s, rising unemployment rate, I think makes sense for their currency to be weakening. For other currencies that I think are important, meaningful changes is regulation of cross-border parcel trade. So that would mean that you could have a distribution center potentially on a border state like Michigan and serve clients in Ontario or other markets in Canada. So I think the part of what went into USMCA was negotiating on industries that didn't exist when NAFTA was negotiated in the 1990s, like the internet economy, like e-commerce. And so that, I think, could be one area where we could see some demand for Michigan businesses and hiring over the next year out of this. So that is, thank you again for the invitation to speak, and thank you all for listening.